Welcome back to the Plan Future Insight. Today we are talking about something very close to my heart. The biggest mistakes investors make, and how you can sidestep them completely. Let's start with the simple truth. Most people learn these lessons by losing money. But you are smart to learn them beforehand. So let me share what 20 years of experience has taught me, starting with the most common mistake of all. First, the FOMO trap. Jumping in when everyone else is celebrating. We all feel it. When a stock or fund is making headlines and your neighbor is bragging about 50% returns, it is tempting. But by then, the smart money is usually booking profits. Here is DADA's rule. When the cab driver starts giving stock tips, it is time to book profits. Avoid buying a trending asset just because it is trending. Use the valuation deviation check. If the Nifty PE is 20% above its 10-year average, it is in euphoria zone. Wait for a pullback. Second, panic selling during a downturn. The cut rate mistake. When the market drops 15 to 20%, your brain screams save your money. This is the single biggest wealth destroyer. In 2008, my clients who stayed disciplined in their regular SIPs came out with 3 times wealth by 2013. The ones who panicked and excited locked in their losses forever. DADA's rule is simple. A market crash is a sale, not a fire. Never exit equity during a drawdown of more than 10%. Instead, increase your SIP amount. You are buying quality assets at a discount. Third, no goal behind your investment. Investing just to make money is like building a house without a blueprint. If you do not know why you are investing, for retirement, child education, or your dream home, you will make emotional, short-sighted decisions. DADA's rule is clear. Every investment must be linked to a specific goal with a timeline. For short term, less than 3 years, use debt or fixed deposits to protect capital. For medium term, 3 to 7 years, use hybrid or balanced advantage funds for steady growth. For long term, 7 years or more, use equity via regular mutual funds for wealth creation. Fourth, no diversification. Putting all your eggs in one basket. I have seen people lose everything because they invested their entire life savings in their employer's stock or just one sector like realty or IT. A single black swan event can wipe you out. DADA's rule is to build a balanced thali. Large cap, mid cap, small cap, debt, and a little gold. Do not let any one category exceed 10 to 15% of your total equity portfolio. Fifth, chasing past returns. The rearview mirror trap. Oh, fund X gave 30% last year, let me jump in. By the time you do, that fund or sector is often overvalued and poised for a correction. DADA's rule is to never pick a fund based on 1-year returns. Look at 3 to 5-year rolling returns and risk-adjusted metrics like the Sharpe ratio. A fund delivering 15% CAGR with moderate volatility is far better than a 20% CAGR fund with high volatility. Sixth, ignoring inflation. The silent thief. If your money grows at 7% but inflation is 6%, your real return is just 1%. That is barely keeping up. Over 20 years, that tiny difference erodes half your purchasing power. DADA's rule is that your equity portfolio should aim for 12 to 14% CAGR to generate a real return of about 6% after inflation. Anything below 8% nominal is actually losing you money. Seventh, no emergency fund. The foundation first. Jumping into aggressive investing without covering your health and life risks is like building a mansion on sand. DADA's rule is simple. Before investing a single rupee in equity, first build an emergency fund of 6 to 12 months expenses in liquid funds. Then get term insurance of 20 times your annual income. Then health insurance, a family floater of 10 to 15 lakh rupees. Only then start your SIPs. 8th, timing the market. The impossible dream. No one, not even the world's best fund managers, can consistently predict tops and bottoms. Trying to time the market is a guaranteed way to miss the best 10 to 20 days of a bull run. DADA's rule is that time in the market beats timing the market. A 10,000 rupee monthly SIP started just before a crash in 2008 still created over 1 crore rupees by 2023. But someone who waited for the perfect entry in 2009 missed the entire 80% rally. Now, here is what you can do this week. Step 1. Review your current portfolio. Identify any fund with a 1-year return greater than 25% or a Sharpe ratio below 0.6. These are likely rearview mirror traps. Replace them with a consistent performer. Step 2. Within 1 to 3 months, ensure you have a goal-based asset allocation. Write down your retirement age, target corpus like 2 crore or 5 crore rupees, and the required monthly SIP. Use this simple formula. 1 crore rupees in 15 years equals about 17,900 rupees per month SIP at 12% CAGR. Step 3. Within 6 to 12 months, automate your finances. Set up a systematic withdrawal plan for your emergency fund and auto-debit for your SIPs. Remove all emotion from the process. And here is DADA's wisdom of the day. Investing is 10% mathematics and 90% temperament. The biggest enemy of wealth creation is not the market. It is your own impatience, fear, and greed. A trusted mutual fund distributor is your financial bodyguard, there to hold your hand when even you want to run away. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. Thanks. Cost of Bishwas, www.planfuture.in